Okay, step 4. Project financial leverage, financial assets, equity, and financial income items. In this part, we're going to focus short-term, long-term investments. These are two financial assets. Both will generate interest income. So we also focused interest income. Short-term and long-term debt. Okay, they are interest-bearing liabilities. So after we focused short-term and long-term debt, we also focused the interest expense. Next one, we will focus equity. So the equity includes preferred stock, common stock, additional paid-in capital, retained earnings, treasury stock, other accumulate other comprehensive income, etc. Okay, and we've done all the forecast for the assets except the investments in the non-controlled affiliates. Because Apple has no investments in this account, so we simply assume 0 for the next 5 years. But if your firm has some investment in this account, you should either use common size or rate of growth to forecast the balance of this account. Next, we forecast the first financial liability, note payable and short-term debt. So for financial liabilities, we generally use growth rate of assets. The reason is when assets increased, the financial liability also increase. It makes sense, right? Because the assets is financed both by debt or equity, right? So when the assets, the left-hand side of account equation increase, so both equity and the debt could increase. But we do not directly use the growth rate of total assets. We make adjustments by decrease the growth rate a little bit, because debt is not the only source of finance. Okay, decrease like 1.5%. Okay, so the growth rate decreased to 6%. Let me drag. So that's the growth rate for the next 4 years. And Excel calculates the balance of notes payable and short-term debt for us. Okay, so Excel has already input the formula, right? This is a growth rate formula. D180 is a prior balance, and this is a 1 plus growth rate. We do the same thing for other financial liabilities. Okay. So deferred revenue we discussed in the operating liabilities. And all other current liabilities are 0, so we simply assume they are 0 for the next 5 years. The next one is long-term debt obligations. Okay, I think I entered this reference in the past, so I just refer the same growth rate as short-term debt and notes payable. Okay, so this one shares the same growth rate as notes payable and short-term debt. 0, so 0. Deferred tax liabilities. On this one, we use common size analysis. Okay, so if you click this cell, it indicates, okay, it is a function of E169 is actually total assets. Okay, so it's a percentage of total assets. So we need to rely on the percentage here. is about 1%, right? So I simply enter 1%. And deferred tax liability is about 1% of total assets. Okay, the next other non-current liabilities we keep using, right? Keep using the growth rate of both notes payable, short-term debt, and long-term debt obligations, because these are financial liabilities. So the next one is preferred stock. Preferred stock are all zero for the prior 3 years, so Apple did not issue any preferred stock. Okay, there is no preferred stock in the capital structure. Again, we assume zero for the next 5 years. Next one, common stock additional paid-in capital. This one we use a common size analysis. It's a fixed percentage of total assets. If I click this cell, it is a percentage of E196, it's just total assets, right? So we should rely on percentage of prior years. So from 10.1% to 10.4, then to 10.7. It's quite stable, right? So we just pick a average of prior 2 years, about 9.5 or 9.6, 9.5. Okay, so that's the balance of common stock and additional paid-in capital. It makes sense because when companies' total assets increase, the company tend to issue more stocks, right? Or the newly issued stock contribute to the increase in assets. The next one is retained earnings. The forecast of retained earnings is based on the formula. If I click the cell of year +1, you can see this formula. This formula actually is the beginning balance of retained earnings at E93 is net income attributable to common shareholders. We do not use net income directly because some of profits are attributable to non-controlling interest. Right. So the next one is E261, which is here, total dividends. So this is a formula to forecast the retained earnings. And let me show you the formula. Right, you will learn this in financial accounting. Right, ending balance of retained earnings equals to the beginning balance plus net income subtract dividends. Okay, here we use net income attributable to common shareholders. As I said, because some profits are attributable to non-controlling shareholders. So we have the beginning balance of retained earnings. We have already forecast the income attributable to the common equity holders. We need to forecast the dividend. Right? So we can forecast dividend in this box. Okay? And the common dividend, if you click this cell, the formula is E93 multiple E259 of 256. 256 is a percentage. Actually, this is a dividend payoff percentage. And E93 is actually the income attributable to common shareholders. And here I simply enter a number randomly, like 50%. You can do 30, 60, 90, 100, or 0. It doesn't matter. Okay. But if the company disclose their payoff rate, you can use a payoff rate. Otherwise, this number does not matter, because later on in chapter 11 you will learn the interest payoff policy is not relevant to the fundamental value of the shares. Okay, so we enter 50 here first. Okay, so the dividend is 3,921 for a year plus 1. Okay. Okay. So this is forecast of retained earnings. Accumulate other comprehensive income. By definition, we know other comprehensive income are unrealized income. Okay. And these income are from the change of exchange rate, interest rate, right, or both negative and positive effect. They can be cancelled each other. So I just assume the growth rate is 0. Okay, so we keep using the original prior year balance for the next 5 years. The next part is non-controlling interest. Okay, here is 0. So we keep applying 0 for the next several years. If your company has a non-controlling interest, I suggest you to use the latest balance for the rest of 5 years. Or you can use common size the rate of change to forecast non-controlling interests. Here we don't talk about treasury stock because the template you use just set the treasury stock as a flexible account. And the flexible account is used to balance the accounting equation on the balance sheet. And this topic will be covered in step 6. Now we just go to the forecast interest income and interest expense. Both interest income and interest expense are reported after operating profit. And interest income is generated from interest-bearing investments, financial investments. Actually, the template, if you click the cells here, okay, so this row we are going to enter the average interest rate for the financial assets or financial investments. And these 4 are actually the balance of average balance of cash and marketable securities. Okay. Because some cash equivalent can generate interest. For example, CDs, okay, or saving accounts, right? So they are cash equivalents, or some investment in the treasury bill. They are also considered as cash equivalents. So they can generate interest. And there is no other financial assets for Apple, so we just use the average of these 2 accounts as the principal to calculate the interest income. And in general, for short-term, the return for the short-term investment, now we just assume 1%, which is reasonable, okay, or you can do 1.5. It doesn't matter much because comparing with operating profits, the interest income is very small or very minor. Okay. The next one is interest expense. So interest expense is determined by the average interest rate and the financial liabilities. Okay. So here Apple do not report any interest expense in the past. Okay. Actually, if we go to the SEC and find the financial reports of Apple, I use it 2016 10K interactive data. So we click the table, notes table, and debt. See, that's all the company's debt and the effective interest rate of the debt, right? So this is actually the Apple incurred interest expense, but why Apple do not report any interest expense in their financial statements? Okay, I believe the reason is they capitalize the interest expense into other assets accounts. Okay, so you can simply keep using 0, right? But if you want to calculate or forecast interest expense, we have methods. For example, if you click the cell here, it provides formula. The formula is E63 actually is average effective interest rate and multiple the average balance of these financial liabilities. They are actually notes payable, short-term debt, long-term debt, current matures of long-term debt, and long-term debt obligations. These are all interest-bearing liabilities. Right. The question is how we get the average interest rate for these financial liabilities. Okay, so this is an example from our textbook or Pepsi. We can calculate the weighted average cost of debt. This is amount, the book value of the debt, and we can calculate the weight, right? And this is the interest rate for each debt. We can calculate a weighted average rate is 3.6%. Okay, and this information are also available in Apple's disclosure, right? So you can see there are different type of debts. That's their balance, and that's their interest, right? So you can calculate the weighted average cost of debt. But it's because we don't have time right now, so you can simply pick a number in the middle. Okay, for example, 3.8. Okay, 3.8. So you can simply use 3.8 to forecast the interest expense. Okay, if you want. But here, because it is 0 for prior years, I keep using 0. Okay, otherwise you can enter 3.8 and you can see the interest expense. Right, it doesn't matter much. Okay, so that's the step 4.